Hello and welcome to our monthly, I guess I should say our quarterly podcast, 7 Signs It's Time to Sell Your Business. This is Mike Harvath with Revenue Rocket, and welcome to our show today. Get right at it. The agenda, again, welcome. Thanks for joining. We're going to talk a little bit about Revenue Rocket and who the heck I am. Talk about the problem. Is it the right time to sell? We have some opinions about that. And then 7 signs it's the right time to sell your business. A little bit about the economy and M&A in general. And then things to avoid during the sale, and then we'll facilitate some Q&A. Big thanks to you participants who have already submitted your questions and we'll cover those in the tail end of the presentation. So without further ado, once again, thanks for joining. Here's my contact information. We certainly will be making this presentation recording available on our website as well as the deck, so you can have this for reference. If you need to reach me, I certainly can be reached at either 2 of those numbers or my email below. Further, let's just jump right in. 7 signs it's time to sell. As we think about selling your business, maybe you're approaching retirement. Simply, it's time. There's certainly a huge number, particularly managed service providers in our market who are, approaching retirement. And when they approach retirement, as we approach retirement, they want to, monetize their single largest investment. And the best way to do that, obviously, is to sell. Could be just time to slow down. A lot of people want to do less. Running an IT services company is tough business. There's a lot of moving parts, and we have people who, oftentimes will retire early to pursue other passions that they might have in their life, and they want to sell. Maybe you're just tired, right? And it's time to move on, and thus, you think about retiring. Retirement really isn't an age. It has much more to do with function of where you are in life. And then, I would think a lot about, and we encourage our clients to think a lot about, where do you see yourself a year from now? A lot of times when people are considering the sale of their business, they haven't fully thought through, life after the deal, so to speak. And we think that's an important consideration to think about is, how do we get past and get into the next phase of our life, and what does that mean? Here you're looking for a change, right? Another sign. You're operating your business, maybe you're successful, maybe you're struggling with it, who knows, but you're looking for a change. And oftentimes people will use this term that they're burned out, or that, it's time to move on. And that's just probably more nagging feeling about fulfillment in the work, and that you're not fulfilled in the work. So you do need to change it up. A lot of times when you sell in and you're ready to change, you can find new inspiration in your work. And we encourage people to think about that. Maybe you're looking for a private equity investment, or maybe you're looking to be part of a bigger firm. And then certainly there's, it's time. When you're ready for a change, you can think about, diving into a new industry, right? We've had people who have sold their IT services businesses and done all kinds of things, opened up restaurants. We had one client open up a series of Taekwondo studios. We've had people who have, gone into franchise businesses, all kinds of different things. Maybe become real estate investors. So there's certainly a lot of opportunity out there in all walks of life. And if you're thinking it's time to change, or there's something you're more passionate about, then certainly that'd be a time to sell your business. We've had plenty of clients that have looked for a new startup opportunity, or have an idea that they want to pursue, whether that be in technology or outside of technology. They've been very successful and used proceeds from selling their IT services business to jumpstart that initiative. Matter of fact, just talked to one of those folks yesterday who had sold their business and their interest in that business, and dove in as an investor in a new business that was in an adjacency that they were more passionate about. It certainly worked out well for them. And as I mentioned earlier, maybe it's time to join a larger firm. There's certainly plenty of opportunity to sell in and join a bigger firm that will give you more stability and maybe a little less concern, if you will, of having to manage everything. You want to manage risk. You want to sort of look at how do you de-risk. Oftentimes, a IT services business owner, this is their single largest investment. And when this is your single largest investment, it puts a lot of investment or risk because the market can be fairly volatile, and certainly you don't want to be in a position to risk everything you've spent your whole life building. So, you know, there's many folks that come to us and say, hey, we want to sell because we want to de-risk our investment. We want to have less reliance on this single business. And we want to move on to the, you know, next big thing. And obviously, we often like to steal this one a little bit from some of the superhero movies, but, you know, with great success comes great responsibility. I think the quote was, with great power comes great responsibility. But at the end of the day, when you grow your business to a pretty sizable operation, there's a lot of people that are reliant on you, whether that be employees or customers or family members of employees, et cetera. And with that, you have to sort of be able to manage risk in a meaningful way so that you can continue to be a stable, you know, force in those folks' lives. You might also think it's time to, you know, roll equity forward for a greater return. This is certainly the model in private equity. And there's been a record number of private equity investments in IT services firms, particularly in managed services, in recent times. And doesn't mean that in other areas of IT services, such as cloud services or custom dev or app implementation businesses, that there isn't private equity flowing, because there is. But certainly there's plenty right now flowing into managed services. And it's a great opportunity for individual entrepreneurs to maybe take a position in equity, sell some of their equity, and become part of a bigger consolidation strategy, one in which they can take as the industry often uses the term, second bite at the apple to exit and move out in, you know, 4 or 5 years from now. Health, obviously always a concern. You know, certainly if someone is diagnosed with a health condition that could negatively impact the company, it might be time to sell. And I think you really have to, you know, think about that, think long and hard about that, based on that diagnosis or based on your current condition. You know, health is certainly an impact and has a factor in determining when it's time to exit. Stress is a big deal. If you struggle with managing the stress of the business, or there's a lot of stress at home because of the sort of path that you've taken on an entrepreneurial business, certainly I think it would be worth looking at potentially selling. And if you have a, you know, work-life balance issue, if that's an issue for you, I would encourage you to think about, you know, one way to solve that certainly is to evaluate an exit and maybe look at working in the sector of a business or selling to a bigger business that would allow you to have more work-life balance. Cash. Certainly it's time to, if it's time to monetize and move on because you need the cash, then you should sell your business. I think in many cases you'll know when that time is right. Certainly as an entrepreneur and someone who started, you know, 3 IT services companies before starting Revenue Rocket and having worked with, you know, hundreds of firms around the world, there's always a moment in time when you ask yourself, you know, am I doing the right thing or am I crazy, right? And so I sort of want to delineate that from you think it's really time to move on and cash out. You know, the other thing to consider is certainly time. You want to time the market. We are in a we'll get into this a little bit more later in the presentation, but we're in a very, very active consolidation period in our industry, which is driving up valuations. We're probably at a record from sort of a deal transaction perspective, but also from a valuation multiple perspective. There's many studies that have different opinions about that, but our anecdotal experience and what we see in the market certainly is this is one of the most active times in IT services in probably the last 30 years as it relates to M&A. And that results in higher valuations being paid and essentially a good time to, quote unquote, time the market if you're looking to exit. You might be in an overvalued segment of the market. We think security services, for example, is an overvalued segment. There's a lot of activity, a lot of deals getting done there. Certainly there's a high degree of need for security services. There's going to be an ever increasing need for security, IT security, incident response, really everything that we could point to in security. But it's a very, very frothy segment of the market right now. There seems to be extreme multiples being paid. And I think if you look at various areas in AI or machine learning or other areas of the market that may be relatively frothy, you may want to look at considering a sale. And probably as it relates to cash and primary drivers, you need the money. For whatever reason. Sometimes people need the money to reinvest in a real estate or just to do whatever they're going to do with it. And it's a time for you to exit. Another reason that you should consider selling is it's time to invest in future growth. You want to keep your business, but hey, you're not really want to be the one that's responsible for everything financially about the business. You might want to have additional skills around you. Certainly, that's a good time to look to sell. As I've talked about earlier, there's sort of this difference between selling in and selling out. And when you sell in, it means you're joining another business typically to play a role that may be more core to your DNA. And I would think that would be something to think about and consider. Certainly, there's this whole 1 + 1 = 3 scenario. You hear a lot in M&A about what that is. And that 1 + 1 = 3 really has a lot to do with, focusing on finding a place for each company who's coming into a merger in particular that they couldn't find on their own. And, finding that through a relationship with a company that complements areas where you're weak and vice versa can certainly be a very interesting way to sell or combine with another business. It sort of dovetails into this, you need a partner to take on the investment required to get it to the next level. Maybe you've grown the business just as far as you can individually, whether that just be based on your skills or based on your interest or whatever it might be, to kind of get to the next level. And you need to partner with, more human capital ultimately to get to the next level. And as such, maybe you sell some equity or you bring in a partner or you allow someone to buy you in, or maybe you sell the whole business and join a company as an employee. And then, as you look at needing other skills, it dovetails all into that as well. Maybe you say you really need a lead sales guy. We find a lot of IT services firms are challenged when it comes to marketing and sales. And, we believe that certainly many of those challenges have to do with strategy. But beyond that argument, they have to do with the human capital element of being able to bring people in that can play those roles in your business and do it in an interesting way. And, many of them, if they're really good at what they do, may want to participate as a partner in the business. The other reason, you should sign that you can consider selling your business is you're approached by a buyer. There's a lot of conversations going on in the marketplace today about folks that are interested in your business, and it's probably at a peak time for consolidation in our industry. And I would certainly recommend that if you're approached by a legitimate buyer, that you take the time to have a conversation with them. You don't really know what's there unless you have a conversation. Certainly, there's been very interesting transactions that have started just by someone being willing to hear out what a buyer has to say. And ultimately, transactions get done. And so I would certainly recommend that if it sounds like a legitimate buyer that has a legitimate need, that you take the time to at least screen that and have a conversation. As crazy as it sounds, it just feels like the time is right to move on. We've I know that's, where the point that I came to and owning and running and managing my businesses before starting Revenue Rocket almost 20 years ago. There was just situations that it felt like it was time to move on. And so I use that as an impetus to facilitate the transactions and selling the businesses that I ran. You've kind of grown it as big as you want it, exceeded your growth goals. So, a lot of times we'll go into as an entrepreneurial start in and say, hey, I really want to grow this to a $5 million business or a 10 or a 20 or a 50. And you achieve that goal and then you go like, now what, right? I'm, achieved kind of everything I wanted to do. And so, maybe it's time for you to consider a sale. Maybe the time is right for you to consider that. And, as we talked about a little bit before, valuations that are at an all-time high, probably for the last 30 years. And, we are approaching a market cliff. And when I think about market cliff, what I really mean by that is, this isn't going to last forever. And we're certainly going to need to be in a position to understand that. And we'll talk a little bit more about that in this segment of the webinar, which really is an overview of the economy and M&A and IT services in general. So as we know, the M&A market will slow down eventually, right? We think this could be the last big year for M&A for a while. There's a variety of factors that are going to contribute to that. One large factor, we believe, will be what sort of happens with China. So if we dismiss a little bit the current concerns about a pandemic around coronavirus, but just look at what will happen with China, and trade relations with China will have a big impact on kind of, we think, how long the bull market in general in the stock market in North America, but also the M&A market will last. If we begin to see some impetus that tips our economy over, we'll probably see a chilling effect on M&A and ultimately a correction period that we know is coming. Now, in some ways, we could argue that I'm sort of the last guy that should be looking at, we'll get the questions here in a minute. I see somebody introduced a question. We will be, I'm the last guy that should be predicting how long the bull market will run because I've been predicting for 3 years that we were going to, slow down. So, maybe you shouldn't be listening to this webinar. But ultimately, we think that, after the election, within probably 2 years of the election, we're going to see a slowdown period as we move into kind of what's going on with the next phase of the economy. A little bit about, what a market shift looks like and what happens. So when the market shifts, and we certainly experienced this during the financial crisis, and we saw it after, Y2K, we start to begin to see that deals can't get done, or they're taking too long, or they require a significant renegotiation. Now, deals are hard to get done to begin with, but they certainly begin to see a macro trend where deals are abandoned. We see that not only for deals in our space, but we also see it more globally, right? We begin to see public-to-public company mergers and acquisitions start to fail. And they get to be very challenging to get done. And we had this real-world example when we represented a company for sale, which, by the way, we represent both buyers and sellers in IT services businesses, but we happened to be selling one to a public company kind of in the peak of the financial crisis, and we had to completely restructure that deal during the height of the financial crisis in the spring of, I think it was 2008. And it required a huge restructuring, predominantly because that stock in that public company had lost over half its value from the time we structured the letter of intent until we got to the deal. And so you need to be aware you're going to start to see that. So deals can't get done, or they take too long, or they get canceled. We'll also see the number of transactions go down dramatically. And part of the reason that is there's declining multiples in which buyers certainly would be interested in doing deals, but sellers will pull their companies off the market or not be interested in doing a deal at a discount. And so the available inventory for companies literally goes down. And you would think, well, available inventory goes down, you'd think the price will go up. Not really, because it's just people won't agree to take sort of the where the businesses are being sold right now. And certainly the deals that do get done are much more contingent, less cash. Right now we sort of see a peak for the amount of cash that's being paid in transactions, but with these lower multiples paid, oftentimes you see these contingent payouts or earnouts becoming to be more predominant. So the question is, have you already started down the path of a sale? Maybe, it's certainly something to think about, some things to avoid if you're already kind of in the market looking to sell your business or entertain a conversation, or maybe you're negotiating a deal right now. So what is the problem if you're mentally ready to sell, but you haven't really begun? And I think waiting too long to get a deal done is a problem, right? So if you're sort of mentally checked out and you want to sell, don't wait till 3 months before you want to retire to start a process, or you're, would like to be done with this business, and you expect it to be done in very short order. Typically, and I know one of the questions later asks, how long does it typically take to run a sell-side process? And we typically say it's about 9 months, can be up to a year, depending on the situation. And we think that if you're going to proactively take your firm to market, you need to be thinking ahead. You probably need to be thinking ahead a year or two in advance of that to make sure that your financial house is clearly in order as well. So, the best policy is always to run the company efficiently and to drive profit, because that is the single biggest driver of your value in an M&A transaction. And ultimately, make sure you leave a much lead time. The other kind of thing to avoid is to ask too much or too little for your business. So it's critically important that you get outside valuation support as it relates to the business, and to get a good feel for market valuation paradigm, so you know that the business is being priced right. Just like anything, right? If you go to sell your house and you price it way too high, you're not going to sell it, right? And certainly you don't want to give it away. You want to make sure that it's priced versus the market. And the best way to do that is to hire a competent valuation source and an advisor to be able to value the business properly. Also, selling to the wrong buyer is a really bad idea. We see a lot of transactions occur where people may just look at the money, and it's really not the right money. It's not the right buyer. There isn't good synergies. You don't get to 1 + 1 = 3. And because of that, we think it's best to take quite a bit of time to vet a buyer and do your own diligence on that buyer, and make sure in particular that there's a strong cultural fit with that buyer. If there's sort of a nagging feeling in the pit of your stomach that this is the wrong buyer, then you probably shouldn't do that deal, because those cultural fit mistakes will be sort of a big problem. And this isn't really on the avoid list. This really should be on a should list, which is the last bullet, which talks to, you really need to find a competent advisor to represent your business for sale. Super important thing. It's tough to find, it's tough to get a deal done no matter what. And you're in a much better position to do so if you have an advisor that's advising you on how to best bring that business to market and finding buyers for you in the space. We just think that in the end, not only are you going to optimize your value in the business, but much more importantly, you're going to have someone to take you through a process that is very, very difficult. It's been called the most unnatural act in business for a lot of reasons. And you need a coach and a mentor to help you position and package your business for sale, and ultimately take you through to the successful conclusion of the deal. So now we're going to jump into Q&A. I'll see if there was a question that Evan looks like he put in on the Q&A panel. What does involving a firm like Revenue Rocket cost the seller? That's a good question. So I'll address that as well as some of the other questions that were submitted earlier. Typically, a firm like ours charges a retainer to help you package a firm and ultimately market your firm to the marketplace, and a success fee. And I would say most competent brokers do the same thing. So it is not atypical for someone to focus on that kind of packaging. Now, the thing I would be concerned about certainly would be, how does that retainer get charged? Well, that retainer gets charged in one of two ways: either a large upfront retainer for packaging the business and marketing, and then a success fee, or a pay-as-you-go model. Now, we as Revenue Rocket tend to do the pay-as-you-go model, which we think is more fair. The challenge with a large upfront retainer, and we define large as, it's usually $50,000 or more, is that you can't really see how well the firm is going to perform for you until you've already committed to $50K. It's sort of like a house painting analogy. You don't know how well a house painter is going to paint your house until after it's done. Same thing with this type of structure. We think a better way to do it is a more pay-as-you-go model, one where you can see the performance as you go, and it's certainly one that's much more affordable. And then ultimately, success fees tend to be about the same across our industry. They don't vary too much. They usually are indexed on the sales price as well as a variety of other attributes that get calculated into the sales price, such as working capital harvest and maybe compensation for principals if you're going to stay. So what we'll call the value of the deal. Then I have another question online here that talks about the value. How do you value a services business? Essentially, valuing a service business has to do predominantly with calculating a percentage or a multiple of EBITDA. And generally, we say that those calculations, although this is a very broad brush, and I want to caution that multiples of EBITDA for the last year are not valuations. Valuations do look at a variety of history, 5 years of history of the business, the balance sheet, a forecast, a variety of other attributes and things in the business that are required to do an effective valuation. So the best way to understand what value you're going to get in your business is to hire someone to do that valuation. Revenue Rocket happens to do hundreds of those a year, so we certainly are a firm that could help you with that as well. But in the end, if you think about generally a 6 to 8 times trailing 12-month EBITDA number is one that we think works pretty well. And certainly is a good benchmark for you to value a business. Now, if it's a very small business and we define that as a business that's maybe $1 million a year or less, or one that has pressure on profitability, one that's typically operating in less than 6 or 8% EBITDA range, there may be downward pressure on that valuation multiple. Likewise, if it's a larger business, let's say over 10 million in revenue, maybe upwards of 20 million in revenue, and it's operating in the top quartile of EBITDA range, which we believe is above 13% EBITDA, then certainly those types of businesses can command a bigger premium. So if you look at some of the questions that were submitted earlier, we addressed the question about time frame to market your business and how long does it take to get a deal done. And typically that's at 9 months is typically what we say, but 9 months to a year isn't atypical. And then should your deal be exclusive to one broker? We have to do, when we think about selling your business, most brokers will require some sort of exclusivity. And that exclusivity can vary. For example, exclusivity can be defined simply as a buyer that is introduced by the broker. Or it can be any buyer. And I think you need to be somewhat careful with how you engage a broker. We tend to be of the ilk that you provide an exclusive based on the buyers that you've introduced to that sell side process. If some buyer comes in from the outside and we're not involved with that, we don't necessarily feel like we should be collecting a fee on that. However, I would tell you that many brokers do feel that they should collect a fee regardless of how that buyer comes to you during the exclusivity period, and we don't think that's necessarily fair. So that's something to consider as you're looking at a broker. How do they deal with exclusivity? We think that's a trap that a lot of people we know have sort of fallen into. and we'd recommend that you think long and hard about those types of relationships if someone tries to have an overreaching exclusivity. So, as we look at another question that we had submitted, the question was, how do you sell a services business in reality as it relates to, really an active and past client list? And what I mean by that is, I guess, you may have a business that's maybe more small or more nascent, and it's simply a client list. And I think, the strategic buyer in that case would be someone who's a competitor, probably. Someone that you could go to and say, hey, we got some active clients. We're not really small. We're not really actively running the business. We have some past clients that, probably don't have any value, frankly. But if they're active clients, there's value there. And we just want to sell the client list so it can be serviced. Certainly there's brokers that can help with that, but the best way to do that may be simply to approach a competitor that's in the space, maybe in a different part of the country that may want to be in your area of the business, and ultimately, or your area of the country, and have a conversation with them about that book of business and how that book would be applied. Now, you should know that you would need to normalize profit or EBITDA in that situation. It's not atypical for us to facilitate the sale of a book of business or the acquisition of a book of business. And when that happens, there needs to be a pro forma financial built around what the cost would be to run the entire business. It's not simply, hey, this book of business spins off this amount of gross profit, and thus I should get a multiple on that. That's not really how it goes. You have to look at what costs would be incurred to run that as a going concern, and that model has to be built in order to have a buyer take you seriously on what the sale would be. So here's the question: is how is the market for the acquisitive of a small, less than $1 million business in a small area, like in a small community? And I'd say that the market is pretty good, actually. We see a lot of businesses of different sizes reaching out to acquire companies of all different sizes, and certainly adding a small business to a portfolio that makes sense strategically and culturally can be a great way for, let's say, in that case, a $4 or $5 million business, if you're looking to buy a $1 million business, to expand their footprint. So I wouldn't rule out that a business of any size in IT services could be marketed to the market. You just need to understand that you're not going to get a premium for a relatively small business. The best way to command a premium, of course, would be to have a bigger business, typically above, what we would consider, and most buyers would consider, sort of sustainable viability without the principal being involved. And we think those numbers are about $3, $4, $5 million. But it doesn't mean that if you're selling in and you're selling a smaller business, that you couldn't be effective at ultimately selling your business. Here's a question about, what does a strategic buyer look for most in a potential purchase? So there's a lot of discussion about, what is a strategic buyer, what is a financial buyer. A strategic buyer is typically an operator or someone who operates in the business, and you might consider to be a competitor somewhere, right? Someone who is looking to grow the business through acquiring your firm. Now, maybe it's someone who offers a complementary service. That could also be a strategic buyer. Experience has taught us that strategics tend to pay a little more than financial buyers. They tend to be more focused on finding the 1 + 1 = 3 long term. And what they look for in an acquisition, usually in our industry, are capability and an offering that they don't have, or geography, an area that they don't have, or people. Maybe they're looking for a leader for that area of the business, the entire area of the business, or they're looking for a group of people that could complement what they've built. Usually it has to do with a broader organic expansion strategy. So the best strategic buyer is someone who's already determined that they want to be in, this area, with a set of services that you offer, and they're contacting you because that's consistent with their strategy, which means that organically they're going to build it or buy it or both. Likewise, they're trying to find a way to grow and extend the business strategically, one that may be faster and cheaper. Certainly acquiring the business is, in general, a much more cost-effective way to expand into a new market, whether it be vertical or service offering adjacencies or geography, than building it from scratch. It's certainly much more proven because you can calculate your return rates much more accurately than if you build it from scratch. So, a strategic buyer is looking for something that's going to complement their strategy. It sounds a little crazy, like, yeah, it complements their strategy, but in essence, it has much more to do with, people or geography or vertical that aligns with their business. And then, there was a question here about the KPI to expect in selling an MSP. Is it, MRR or EBITDA? And what should the multiple be? So we have pretty strong opinions about that for those of you that are managed service providers or on the webinar. We think it's much more important to focus on a measurement of profit. Now, with that said, I would tell you the more marketable MSPs tend to market that need at least 50% of their revenue to be MRR. Now, there's some pundits in our industry who focus on the percentage of MRR and a multiple of that MRR to be a valuation driver. We think that's foolish. And the reason why we think that's foolish is because you can't calculate a return from a buyer's perspective based on any sort of index of revenue, including monthly recurring revenue. The only way you can calculate return is based on profit realization. So you want to look at how profitable is the business, right? How profitable will the business be post-transaction, and when can you expect to get a return rate? And oftentimes that drives value and valuation, much more so than a multiple of EBITDA. And so we've certainly seen people pay high multiples of EBITDA. I mentioned 6 to 8. We've seen people pay as high as 14 or 15 times trailing 12-month EBITDA because there was great synergies, and their ability to get to their return rate as a buyer was enhanced by that acquisition, and they could still justify paying a premium. Now, those transactions are rare, but you should know that they do exist. So, I would tell you to answer the question much more directly, we think it has everything to do with profit, and certainly companies that are much more attractive from an MSP perspective are ones that have at least 50% MRR. So with that, I think unless there's any other online questions, which I'm certainly happy to take, we can focus on wrapping it up. So if anybody else has any questions, I'll give you all just a moment to submit them via the question panel, Q&A panel, or the chat panel, and we can see where we go from here. Certainly it lets you go early. Again, I'll put my contact information up while we wait. And if you guys have any questions, you can certainly email me directly or feel free to reach out via phone or text or however you might want to do so. And we can have a conversation. So Doug entered a question about how does engagement with us begin? That's a great question. In essence, we start all of our work with our clients with a readiness review. And part of that readiness review in the first month of our work together is to really look at, are you ready to sell? We think that seems like an easy question that someone might want to answer, but you need to know the value of the business. Market valuation is part of the work we do at our first month of our work together. We do a readiness review, and we come back and recommend, hey, if you're not ready to sell right now, maybe you should engage us or another firm in a strategy improvement initiative so that you can optimize value. And so we take that readiness review very seriously. And it involves quite a bit of intel and sort of diligence on our part, as well as running your valuation, so we can be very upfront and cognizant about what is your business really worth, right? What should you do to, optimize value, if that's something that you should do, or even if you should go to market yet. And then after that, there's a whole series of things, and certainly we have a workflow that we'd be happy to show you guys, and a little PDF we put together around sell side that can answer some of these questions as well. If you're interested in receiving that, certainly just drop us an email, drop me an email directly, and I'll make sure that you can get that PDF. And it talks about sort of the whole M&A process workflow from a sell side perspective and sort of how we see the world from there. So with that, I think we'll tie a ribbon on it, as we often say here, Revenue Rocket, in our podcasts and other marketing. I encourage you guys to listen to our Shoot the Moon podcast, which can be you can find on iTunes or Spotify. We do record a weekly podcast on M&A and strategy and IT services. And this particular session will also be available via our website in the coming days if you'd like to review it. So with that, we'll call it. Thanks a lot. I appreciate everyone's time, and have a great day.